What's up, everybody? Welcome back to The Contrarian. Today I'll be taking a look through Vitaliy Katsenelson's recently written article on Are Housing Prices About to Drop? For those of you who aren't familiar with Vitaliy Katsenelson, he has a website called Contrarian Edge. He's a value investor. He's pretty well known out there, but I really like to take a look through his articles, and this is a very educational one in terms of laying out the framework for why housing prices are, in his opinion, very likely to continue to go down because, as he simply puts it, you cannot have both mortgage rates and housing prices going up at the same time. Something will have to give. So that's a brief introduction to who Vitaliy is, but now I'll get into his article on why the housing market is worse than you think. Basically, in this article, he'll be exploring the impact interest rates will have on the economy and especially the housing market. Currently, the 30-year mortgage rate is pushing 7.6%, up from less than 3% a year ago, while the median house price in the US is up 37% from $320,000 in 2019 to $440,000 today. You cannot have both interest rates and housing prices making new highs. Something has got to give. Let's start with new home buyers, as they'll be impacted the most. If you are a first-time home buyer, you don't have home equity to roll into a new purchase. If you bought a house in 2019 for $320,000, assuming you put 20% down on the purchase price as a down payment, your annual mortgage payment at 4% would have been around $15,000 a year. Now, 2 years later in 2021, you would have paid $420,000 for the same four walls and white picket fence, dog, spouse, and 2.5 kids sold separately. However, despite a 37% house price increase thanks to Uncle Fed, you would have been able to finance this purchase at 3%, and your annual mortgage payment would have gone up to $17,000 a year, a manageable $2,000 annual increase. As I have mentioned, today the median house price is at $440,000, but the interest rate has skyrocketed to 7.6%. Thus, if you are a first-time home buyer, the same American dream would cost you $30,000 a year. That is a $13,000 increase from just 1 year ago. Let me put this in proper context. Median annual household income in the US is about $75,000 or about $60,000 after taxes. In other words, half your after-tax income is now going to servicing your mortgage if you bought today at peak home prices and rates. So this is the essential conundrum for housing right now, why it's almost a certainty in Vitaliy's opinion that housing prices continue to go down if rates remain this high. But keep going. It is easy to see how the combination of high prices and rising interest rates have turned the American dream of owning a home into a nightmare. For affordability to come back to 2020 at current interest rates, housing prices have to decline more than 40% to $250,000. If this were to happen, anyone who bought a house since 2012 would be underwater on their initial purchase. And this is somewhat of a scary number, some scary arithmetic for some people out there. For example, if you're in the house flipping business, if you're in a real estate investment business, this would be a pretty scary time for you because a 40% decline in housing prices is not small. The stock market does that fairly frequently, but housing rarely, if ever, has done that before. Obviously, the financial crisis is an exception to that, but that's a very scary situation. So, to put it shortly, Vitaliy continues to go on. Basically, the function of how this will play out is, it's going to be a lot more gradual of a decline than the stock market because, unlike stocks, houses actually are a much less liquid market. People actually live in them. There's usually attachment to their own house, so they want to be able to sell it for as much as possible. So it's really going to take time for this to flush out. in the actual housing market for prices to decline this much. And in fact, that there is some debate of, do they actually decline 40% as the supply and demand and rates being where they are would dictate, or at that point does the Fed step in and begin to get involved in some way? And one thing Vitaliy doesn't cover in his article that I think is worth mentioning is back in the early 1970s, when a similar situation was being faced in the housing market, not quite as bad as it is now, because housing prices were not as elevated as they are now back then. But back then, the U.S. government created the 30-year mortgage. Prior to then, it really wasn't a thing. So in doing that, in going from, say, a 10 or 20-year mortgage to now a 30-year mortgage, they were able to allow housing prices to stay elevated, yet offer a government-backed mortgage that the banks would be willing to finance, and then that in turn would allow buyers to continue to buy houses, and it would allow the mortgage payment to decrease from month to month, because it'd just be spread out over a much longer period of time. Now, why am I talking about this? I'm simply mentioning that the U.S. government could do a similar thing today in terms of, if housing prices continue to go down, if that continues to hurt the economy, because as Vitaliy does discuss later on, there is a strong relationship between housing equity, the amount of equity people can pull out of their houses to do, projects that they want to do or spend more money, and the actual economy. So if that continues to hurt the economy, as it already is, if it continues to get a lot worse, the Fed could totally step in, or the U.S. government could step in and say, oh, we're now going to create a 40 or 50-year fixed rate mortgage. And this 40 or 50-year mortgage would suddenly knock down your monthly price, and suddenly people would begin to buy houses again because they'd see the monthly payment go down to something they could afford. Now, obviously, this would be a somewhat unwise decision to make, in my opinion, because, thinking about myself in 40 or 50 years, there's a question of, will I even be alive, 50 years from now, kind of a thing. So I don't like the idea of continuing to have to pay a monthly house payment for the rest of my life. I definitely do, speaking for myself, I definitely want to own a house at some point, completely outright, not having to pay anything for it. So that's just my thoughts, but obviously a lot of other people would think differently. They would totally hop on board with that 40 or 50 year fixed rate mortgage if the U.S. government were to do something like that. But that is something they could do to begin to jumpstart the housing market again. Also, in my opinion, it is just a matter of time until the Fed does need to pivot and rates begin to go back down. So, all that being said, if what Vitaliy is saying actually does come true, then it would be expected that we continue to see a housing market sell-off, housing prices continuing to go down, and just the total volume of houses either bought or sold continuing to stay extremely low as it is now. So all of this being said, let me know what you guys think down in the comment section below about all of this, whether it be the housing market in general, what you guys are seeing in your own housing market wherever you are living. What you think about perhaps the U.S. government stepping in, creating something like what I mentioned, a 40 or 50-year mortgage. It's definitely not unprecedented, or something else entirely, such as the Fed pivoting. But let me know what you guys think in the comment section below, and I hope to see you all again at some point.